Hi, and welcome to Funding Juicy Solutions. I'm Juice Ortiz, and today I want to dig into the debt service coverage ratio loan, DSCR, a little bit. So with the DSCR loan, debt service coverage ratio, the DTI is not based off of the borrower's income qualifications, but instead the income revenue stream of the home. Say you have a home that can rent at $2,500 a month or $2,300 a month. So long as your mortgage payment can stay under that revenue stream, the monthly revenue stream from that property, you qualify for this loan. Now, there's a couple caveats you need to be aware of. A, the owner's personal debt does not matter. B, the mortgage debt of the house cannot exceed the income generated from that property. And C, since the DTI depends solely on the ratio between the mortgage debt and the income property, cash is king. A borrower technically does not need a job to own this home. Now, I know what you might be thinking, that's what happened way back in the mortgage meltdown. No income, no asset, state income, state asset. All right, we're not saying any of that. What we're saying here in a debt service coverage ratio is that the income generated from the property or the home is going to cover the debt of the mortgage. So there still is an income requirement. It's just not based off of the borrower. What is needed is an income appraisal, which will tell the bank or the lender what the income value is of that property. Assets. You're going to have enough cash or liquidate enough investments to get enough cash to put a big enough down payment down in order to lower the LTV to an amount in which the mortgage is low enough to be covered by the rental income. So plan on having 6 months reserves or 12 months reserves. And a reserve is basically if the house costs, again, $2,300 a month, then 1 month reserve is $2,300. 2 months reserves is $4,600. So if you have 6 months reserves required to get into this loan, just in case the home goes vacant, say that's the lender's requirements, then you're going to have $2,300 times 6 months. That much cash has to be in the bank available to pay the mortgage if the property goes vacant. Now, although technically you do not need a personal income for this type of loan, you do have to have a good enough credit score, which is typically going to bottom out around 660, maybe 640. So if you're looking for another opportunity to get into investment property, say you have a house and your debt to income is already 45% or maybe even 50%. Maybe you have a VA loan where you're approved at 60% on your primary house. So you don't have enough room in your debt to income to get another loan for an investment property. This loan could work because, again, it doesn't look at your income and it doesn't look at your debt. It only looks at the income and the debt ratio of the house itself. You just have to be consistent on your payments, your regular bills every month, to have a high enough credit score to qualify to get this loan. Thanks again for watching. Again, whatever your situation, there's a juicy solution waiting for you. Shoot me a call and let me know how I can help you. I'd love to help.